The consumer discretionary sector ranks fourth out of all sectors in our second quarter 2014 best and worst ETFs and mutual funds by sector. As you can see in figure 1, my top rated ETF is the State Street Consumer Discretionary Select Spider, ticker XLY. My least favorite ETF is iShares US Home Construction ETF, ticker ITB. Figure 2 shows my best and worst mutual funds. My top rated consumer discretionary mutual fund is Fidelity Select Portfolios Leisure Portfolio, ticker FDLSX. My worst rated consumer discretionary mutual fund is the Rydex Series Funds Leisure Fund, ticker RYLSX. Looks like Fidelity does a little better job with the leisure funds than Rydex. Figure 3 is one of my favorite tables because it shows you, the client, exactly how well ETF providers and managers are doing in the sector by showing you how many stocks actually get a good rating versus how many funds are picking those stocks. I think that's very telling. Figures 4 and 5 show you the landscape for ETFs and mutual funds and exactly how many funds and how much capital is allocated across our rating spectrum for ETFs and mutual funds in each rating category. My top rated stock, or my favorite stock in this sector, is Ford. Great track record of profit growth. In fact, since the financial crisis, the company's grown profits at 42% compounded annually. And yet, the current stock price at $16 a share implies the company's profits are going to permanently decline by 10%. Given the recalls and competitive pressures with GM, I don't see Ford doing anything but taking market share. They've got one of the highest returns on invested capital we've ever seen in the automotive industry, and it's trading as if its profits are going to decline by 10% permanently. Good risk reward there. One of my least favorite stocks, Vulcan Materials Company, ticker VMC. This company hasn't grown profits at all. In fact, they've been declining 6% compounded annually over the past decade. And yet the valuation of the stock, way too high. To justify $66 a share, the company's got to grow its profits at 11% compounded annually for 37 years. Really high expectations for a business that's been struggling. Investors should avoid.